It is 7:14 on a Monday morning. You open your banking app while standing in line for coffee. Your balance is $11. The coffee costs $5. You tap your card without thinking about the automatic payment scheduled for later that morning. By lunchtime, your balance is negative. The mistake was small, but the consequences may not be. A fee could appear. Another payment could fail. A late charge from a different company could follow. One forgotten transaction can spread through your financial life faster than the original purchase ever could. Now imagine opening the same banking app years later. The institution that once made you wait on hold is calling you first. A banker knows your name. Fees disappear after one message. Loan terms become negotiable. Investments you have never seen advertised are brought directly to you. It is still a bank. You are still you. So what changed? The number beside your name changed, and with it, the economic value of keeping your business. This is how banking can change at every level of wealth, from almost nothing to $10 million. But there is an important truth before we begin. Banks do not judge customers using one account balance alone. Credit history, income, direct deposits, debt, transaction patterns, invested assets, and the products you use can all matter. Still, as the amount of money you hold with an institution grows, the relationship can change dramatically. At the first level, you have almost no financial margin. Your balance moves between $0 and a few $100s. At this stage, the bank is not helping you manage wealth. There is no wealth to manage. The account is primarily a payment tool, a place where income arrives and bills leave. The problem is that small disruptions can become disproportionately expensive. A subscription renews one day earlier than expected. A utility payment clears before your paycheck. A temporary hold at a gas station reduces your available balance. Nothing about the transaction is enormous. But when your margin is close to $0, timing becomes a financial event. Depending on your institution and account settings, you may face overdraft charges, return payment fees, or penalties from the company that did not receive its money. The bank may provide automated alerts or low balance notifications, but personalized attention is unlikely. When you call, you enter the same service system as millions of other customers. The institution is not necessarily trying to punish you personally. You are simply in a segment where providing individual attention would cost the bank more than the relationship is expected to generate. That is the first transformation. At this level, money becomes timing. A few dollars arriving on Tuesday instead of Monday can change which bills get paid, whether you can drive to work, and what you eat that week. Now your balance reaches $500. You are no longer constantly negative, but you are not financially secure. One car repair, medical bill, or missed paycheck could erase everything. The bank may begin offering you basic credit products, but the offers may be expensive, limited, or secured by your own deposit. You may qualify for a card with a small limit. You may receive promotional emails about personal loans. The bank has begun to see a potential buyer. That does not mean the bank believes you are wealthy. It means your account behavior suggests that you may be able to make monthly payments. This distinction matters. A bank can offer you more credit before you have built more security. The ability to borrow can feel like progress, but borrowed money and owned money are not the same thing. A credit limit may increase your spending capacity while leaving your net worth unchanged, or making it worse. This is the first trap on the wealth ladder. Banking can become easier before your financial life becomes stronger. At $500, money becomes breathing room. But it is still only one emergency away from disappearing. Then you reach $5,000. Your paychecks arrive consistently. Bills clear without drama. You maintain a buffer in checking and begin moving money into savings. The bank systems see a pattern. Regular deposits. Lower likelihood of missed payments. More opportunities to offer products. You may qualify for better credit limits, promotional loan rates, or an account with fewer monthly charges. You begin to notice that certain fees are avoidable when you meet balance or direct deposit requirements. This is one of the strangest features of banking. The less financial margin you have, the harder it can be to satisfy the conditions that eliminate fees. Once you have enough money to avoid them, the fees that once mattered begin to disappear. At $5,000, you are not a private client. You probably do not have a dedicated banker. But you are no longer invisible to the sales system. The bank may see you as a customer who can use a credit card, auto loan, savings account, or investment platform. You receive more offers because there are more ways to earn revenue from your relationship. Money has become stability, but to the bank, you have become potential. Now your combined balances reach $25,000. Perhaps some is in checking, some is in savings, some is invested through the bank's brokerage platform. This is where the experience may begin to feel more personal. You might receive access to a preferred service tier. A representative may contact you for a financial review. Certain wire fees, account charges, or service costs may be reduced or waived. The bank is not doing this because $25,000 makes you extraordinarily wealthy. It is doing it because your relationship has become worth protecting. You now have enough money to move elsewhere. A competing bank could offer a cash bonus, a higher savings rate, or lower account fees. For the first time, your ability to leave has measurable value. That changes the conversation. When a charge appears, you may have more success asking for it to be reversed. When you apply for credit, the decision may reflect not only your income and credit score but the broader relationship. However, this level contains another trap. A larger balance can make larger mistakes possible. You may receive a higher credit limit and mistake it for permission to spend. You may be offered an investment product and assume that an offer from a bank is automatically the best option. You may borrow for a more expensive car because the monthly payment fits. The bank's increased attention is not proof that every product is good for you. It is proof that you have become a more valuable customer. At $25,000, money becomes leverage. But leverage works in both directions. It can help you negotiate or help someone sell you more. At $100,000, the language changes. You may be called a preferred, premier, or priority client, depending on the institution. You may have access to a dedicated relationship manager, specialized service number, or enhanced account benefits. When you walk into a branch, an employee may guide you toward an office rather than the standard teller line. The change can feel personal. Someone remembers your job, your family, or the house you mentioned wanting to buy. But personalization in banking has an economic purpose. Knowing your goals helps the institution understand which products you might need next: a mortgage, an investment account, a business loan, insurance, retirement planning. The relationship manager's job may include helping you, but the relationship also gives the bank more opportunities to keep your assets and earn revenue. At this level, another important shift occurs. The bank begins looking at your future value, not only your current balance. A professional with a strong income and $100,000 today could become a client with several million dollars later. Banks know this. They do not merely compete for existing wealth. They compete for wealth that is still being created. At $100,000, money becomes attention. You are no longer simply processed. You are cultivated. Then your investable assets reach $500,000. The bank may introduce you to a wealth management team. This is not yet the world of ultra-wealthy family offices, but the conversation becomes broader. Instead of asking whether you need a new credit card, an advisor may ask about retirement, taxes, estate plans, business ownership, and risk tolerance. The meeting may happen in an office, through video, or at your workplace. The service feels consultative rather than transactional. But you still need to understand how the advisor and institution are compensated. Some advisors are paid through asset-based fees. Some may receive commissions. Some operate under different legal standards depending on the service being provided. The polished presentation does not remove the need to ask questions. How much does this cost? What conflicts of interest exist? Are there lower-cost alternatives? What happens if you leave? At this level, the bank may offer lending against assets, allowing you to borrow without immediately selling investments. That can provide flexibility, but it introduces risk. If the investments fall sharply, the lender may demand additional collateral or reduce the credit available. This becomes the central crisis of the ladder. You have accumulated more money. You receive better service. You can access more sophisticated tools. But sophistication does not eliminate danger. Sometimes it simply gives danger a more professional name. At $500,000, money becomes a system. Your accounts are no longer isolated numbers. They interact with taxes, investments, debt, time, and family decisions. Now your assets reach $2 million. You may qualify for private banking or a higher wealth management tier, although minimums vary widely across institutions. You are assigned a smaller team. Calls are returned quickly. Large transfers receive direct attention. Mortgage terms, credit lines, and account structures may be customized around your overall financial position. The bank may consider your income, investments, business interests, and future liquidity together, rather than evaluating one product at a time. This is where the mathematics of the relationship begins to reverse. When you had almost nothing, the bank might earn small amounts from fees and basic products. At $2 million, a long relationship can generate significant revenue through investment management fees, lending, custody, foreign exchange, trust services, and business banking. Losing you is no longer the loss of one checking account. It could mean losing an entire financial ecosystem. That gives you negotiating power, not unlimited power, not the ability to ignore lending standards or regulation, but enough power to ask whether a published fee, rate, or requirement can be reconsidered. At $2 million, money becomes optionality. You can choose among institutions, advisors, financing structures, and investment platforms. The bank is no longer merely evaluating you. You are evaluating the bank. Then you reach $10 million in investable assets. At this level, the relationship may extend beyond traditional private banking. You may work with specialists in estate planning, concentrated stock positions, charitable giving, business succession, trusts, tax-aware investing, and customized lending. A private banker may coordinate with your attorney, accountant, and investment advisor. Opportunities may be presented before they reach ordinary retail channels, though exclusivity does not guarantee quality. Loan pricing may be negotiated. Collateral may be structured across several accounts. The institution may host private events, market briefings, or meetings with senior investment professionals. But the greatest change is not the room, the title, or the speed of service. It is that the bank now sees the entire relationship as strategically important. Your assets can produce revenue for decades. Your business may create additional accounts. Your family may become future clients. Your referrals may bring in other wealthy relationships. The bank is no longer asking what product it can sell you this quarter. It is asking how it can remain part of your financial life for a generation. At $10 million, money becomes influence, not absolute influence. Banks still have policies, regulators, and risk limits. But many features that once seemed fixed now appear flexible. Service levels, fees, loan structures, response times, minimums, access. The system did not suddenly become kinder. The economics of the relationship changed. Now, return to that Monday morning. You are standing in line for coffee. Your balance is $11. A $5 purchase and an automatic payment are about to collide. At $10 million, a $5 mistake is meaningless. At $11, it can rearrange your week. That may be the most important lesson. Money does not only change what you can buy, it changes how much damage a small mistake can cause. It changes how long you can wait. It changes whether a problem becomes an emergency. And eventually, it changes how institutions compete for your attention. You remain the same human being at every level, but money becomes margin, then stability, then leverage, then attention, then a system, then optionality, and finally, influence. The bank did not become a different institution. Your money became a different kind of relationship.